Proper exposure management can be implemented based on one of two rules: stable investment with low risks using the strict 5/15ths rule for risk management. 5/15ths refers to the investment percentage in a single trade relative to the investment's percentage out of the entire portfolio. For example, if an investor has a $10,000 account, he can allow himself to risk up to 5%, meaning $500 on any single trade, and up to $1,500 of the entire portfolio. In other words, if the investor risks $500 on a single trade, he can concurrently open a maximum of 2 other trades at an additional risk of 10%. The total risk of all open positions must not exceed 15%. Aggressive trading with high risk. This involves the more permissive 10-30 rule for risk management. The more permissive rule allows the trader to risk up to 10% on each trade with a maximum of 30% of the entire portfolio. This rule is intended for traders who prefer aggressive trades or for traders with small accounts in order to provide them a certain degree of maneuvering room. For example, if an investor has a $10,000 account, he can risk a maximum of $1,000 on any single trade and up to $3,000 of the entire portfolio. In other words, if the investor risks $1,000 on a single trade, he can open a maximum of 2 other trades concurrently for additional risk of 20%, with the total risk of all trades being no more than 30%. In general, the permissive rule is considered to be the highest level recommended for risk management. It's best to try gradually reducing total exposure down to the stricter level of the 5/15ths rule. How are pips calculated? We take the amount of the transaction that we have performed in terms of the base currency and divide by 10,000. This is the value of 1 pip in terms of the counter currency. For example, for a transaction of 100,000 euros, we divide by 10,000 and we get 10. This means that the value of every pip is $10. If we execute a transaction of 30,000 euros, every pip is worth $3. For the Japanese yen, the calculation is slightly different. We divide the amount of the transaction in terms of the base currency by 100, and that is the value of the pip. For example, a transaction of $100,000 in the currency pair dollars to yen, we divide by 100, and the result is 1,000 yen. Assuming that the exchange rate is 88.00, we divide the 1,000 by 88, meaning $11.36 per pip. Here's another example. We'll take the currency pair of euros to pounds and a transaction of 100,000 euros. Each pip is worth 100,000 divided by 10,000 and therefore worth $10. And in what currency are we paying in? In pounds, meaning that every pip is equal to 10 pounds. There are 2 basic types of market analysis. Fundamental analysis. This type of analysis tries to predict future market movements according to a country's economic news. Technical analysis. This method analyzes current market movements in comparison to past market movements. In other words, it tries to predict future trends using past movements with the help of indicators provided by your trading platform. Shooting star. This is a reversal pattern that takes place over 2 days and indicates a bearish outlook. On the first day, the candlestick is long and usually green, supporting the major trend. The following day, the price opens near or slightly higher than the first candlestick's closing price and closes slightly lower, with a slightly longer shadow than the candlestick itself. Harami. This is a 2-day reversal pattern that indicates a bearish or bullish outlook. On the first day, the candlestick is long and green and supports the major trend. The next day, the price opens a little lower than the closing price of the first candlestick and closes a little higher than the opening price of the first candlestick. Engulfing plus. On the first day, the candlestick is red and confirms the general trend. The next day, the price opens a little lower than the closing price of the first candlestick and closes a little higher than the opening price of the first candlestick. Downside gap 3. The first candlestick is red and confirms the general trend. The next day, the price opens at a price gap that is lower than the closing price of the first candlestick and closes red, moving downwards. On the third day, the candlestick opens at a positive price gap and closes near the closing price of the first candlestick. Breakaway. This is a reversal pattern with 5 candlesticks and indicates a bullish or bearish outlook. In the bullish pattern, the first 4 candlesticks are red, falling, and the 5th candlestick is green, longer than the average, and closes above the preceding candlesticks. 3 white soldiers. This is a 3 candlestick reversal pattern that indicates only a bullish trend. All 3 candles are green, with the second one closing above the closing price of the first candlestick, and the third one closing above the closing price of the second candlestick.